Fed just released another 2.3 trillion in stimulus, bringing the total to over 6 trillion. And many are expecting massive inflation, even hyperinflation. In this video, I'm going to break down what's happened in the past when money's been printed and injected into the system, what we should expect in the future, and most importantly, how to protect ourselves. So stay tuned. All right, welcome back. If you are new to the channel, my name is Mark Moss. I like to talk about making money. I like to talk about investing money. I like to talk about having overall success. We've been talking a lot about how to navigate these markets, how to protect ourselves up, how to come out ahead, how to survive and thrive in this once-in-a-lifetime opportunity. And so anyway, if you like any of those topics at all, make sure to click the like button right now. Helps other people find the video. And if you're not already, go ahead and click the subscribe button. Hit the bell notification so you're notified every time I put up a new video. All right, now, so today we are talking about the money injection that's been happening, the money printers going, brrr, right? Printing money, building debt, whatever you want to call it, basically injecting liquidity into the system. And it's potential to cause inflation. So as prices go up, as money is created, it causes inflation. Inflation is prices going up. And we see that the cost of milk has gone up, the cost of bread has gone up, the cost of gas actually came down because the oil markets are crashing, homes have gone up, but we're looking over a long period of time and you see that, right? So the thing that's important to understand though, and most people get wrong, is they see prices going up and they think, wow, homes have been such a great investment. Look how much homes have gone up. Or gold has been such a great investment. Look how much it's gone up. But the reality is it's the dollar that's come down in value, and it takes more dollars to buy those assets today. That's inflation, all right? It takes more dollars to buy those. And so when everything else goes up in value except your money, that's what I'm talking about. That's what I'm talking about, inflation. Now, it's real easy. A real fun way to do this is just go to Google and search for inflation calculator, and you'll see a little calculator, and you can put in any year that you want and any amount that you want, and we'll show you what it is in today's dollars. So, for example, in 1971, you could $3,000 worth of goods would cost you in today's dollars $19,000. So $3,000 of goods in 1971 would now cost you almost $20,000 in today's dollars. What does that even mean in today's dollars? Like a dollar isn't a dollar? Like an ounce of gold is an ounce of gold. Why isn't a dollar a dollar? It's because of inflation. As a matter of fact, since 1971, we've seen 500, almost 600% cumulative inflation rate. We'll get more into that in a little bit. Now, there's three basic ways they categorize inflation: increased demand, production costs, built-in inflation, and they're all really saying the exact same thing. At the end of the day, everybody wants to get things overcomplicated, and these, they want to seem really smart. They want to overcomplicate it, but you really need to just kind of break it down. And everything is driven by really only two factors, and that's supply and demand. All right. So when you have more supply than demand, prices go down. Right. When you have more demand, that's deflation. So when you have more supply, more goods, more services, but not very many people want them, the prices come down. So that's called deflation. Sounds like a good thing, right? When there's more demand, when everybody wants it, but there's a very little supply, the prices will go up. It's called inflation, right? Super easy. You don't need to get it super complicated. That's how it works. Now, the government, they've been pushing for inflation. Now, the Fed sets the interest rate, that sets the policy, and their target is 2%. They want 2% inflation per year. Now, on one hand, that means they're creating more money, more liquidity to try to keep prices moving up by 2% a year. Now, I don't know where they get their gauges. Well, actually, I do. I'm not going to make a whole video about this. They use something called the CPI, and they measure what your inflation rate is. However, it's completely wrong. They completely change what assets they're looking at or what goods they're looking at to come up with that CPI. And any person that runs your own household knows that prices have gone up way more than 2% per year. However, That's their target, 2% a year. And they tell us that this is important for the economy to grow. We need to have this inflation. We need the money supply to increase so that things can keep going on. And so what they're really doing is they're pushing you to spend and spend and spend instead of saving. And so what happens is if you go out there and keep spending, they say it keeps the economy moving. And if you save your wealth, it's a bad idea. Of course, today with the whole economy shut down, I doubt there's a single person in the world that doesn't wish they had a little bit more savings, right? So in this world, we've been just told to spend and spend and spend. I bet everybody wishes they had a little bit more. But that's the case. That's where we've been in. Now, if you look at a time when they've been telling us to spend and spend and spend, and the money supply has been losing value, we can look at examples, and it happens all throughout history. It's happening right before our eyes. And the very maybe the biggest example is like the Weimar Republic after World War II. And the value of their currency was losing value so fast that they were having to get paid multiple times a day. They'd get paid, they'd have to run out, buy their goods, come back, work a little bit, go out and buy their goods. Zimbabwe, same thing. Pictures of people with wheelbarrows full of cash just to go buy a little bit of food. And they literally had to go out multiple times a day to buy because it was losing its purchasing power that fast. And like I said, those are great examples. We see it happening right now in real time, right? Argentina, Venezuela, and of course it's happening here. Now, to contrast inflationary, I talked about deflationary. So then we have deflationary assets. So like Bitcoin is a perfect example of that. Gold is also a pretty good example of that. But like I said, the government, the universities that teach us, they want us all to believe that it can't work. We can't have a deflationary currency. We have to have an inflationary currency. And I would just ask you which side of this you're on, right? So just ask yourself the simple question. Would you rather, it's a fun game, would you rather have your money buy more goods and services in the future or less? So if you saved up some money today and you wanted to save it for later, would you rather it buy more goods and services in the future, or would you rather have that savings buy less goods and services? It's pretty simple, right? Of course you want it to buy more, which means you want deflation. Now, the reason why they say that it's not good, they want inflation, is because if you have debt and you have inflation, the debt is easier to pay off in the future because it brings the value down. If you have debt and you see deflation, the debt is harder to pay back. And of course, the government with their, whatever it is now, $24 trillion of debt, they want that inflation so they can inflate away that money. But that's a whole nother conversation I'm not going to get into here. Leave a comment down below if you want me to get in deeper into that. But back to inflation. So we've had a few areas, when we look back like over the last 100 years, we've seen a few areas where we've had really high inflation. So like after World War I, after World War II, we saw huge spikes in inflation with prices going up, right? However, after that, we saw prices coming back down, back into like a deflationary to balance them out. Okay, so we've seen these periods where they balanced out. But where we really saw massive inflation start taking off was right after 1971, which of course I talk about all the time. If you see my videos, you know 1971 is the year we got off the gold standard. And so once we broke the gold standard, we could print as many dollars as we wanted. And of course, we saw massive inflation, massive inflation. As you can see on the chart right here, since 1970, inflation has completely skyrocketed. The compounded cumulative inflation rate is over 2,000% since 1970. Now, like a lot of people want to point to the more recent kind of like 2008 stimulus and say, look, we didn't really see this hyperinflation. So back in 2008, the great financial crash, the markets crashed, the government put in $700 billion, another $800 billion, over $1 trillion. But we didn't see inflation. I guess we could just put in as much money as we want and we won't have that problem. And that's what people are thinking right now. Oh, well, let's put in 2 trillion, 6 trillion. Why not 10 trillion? I'm not going to see inflation, right? Well, yes and no. All right. We need to look at the nuance here. So that's because in 2008, all the money that was put into the financial sector. That means they gave it to banks, they gave it to hedge funds, etc. And what they did is they hoarded that money for themselves. Their balance sheets had gotten completely destroyed. All the debt that they held on as assets got defaulted on, got wiped out. And so the money they got from the government, they hoarded it. They kept it on their balance sheets. And so because of that, it never got down into Main Street. We didn't see it get down into the food and things like that. However, anybody who's been paying attention, if you're watching this channel, then you are paying attention to your investments, you do know that we've seen massive inflation in financial assets. Home prices have gone up like crazy. All types of stocks and bonds and gold have all gone up because all that money was chasing fewer and fewer goods and services. So equities, real estate, energy, all those have gone up since 2008 because of all that money created massive inflation, okay? But this time it's different. This time it's different. Now what we're seeing is some of that stimulus money is going right to Main Street. So yes, the majority, and this is a topic for another video, majority of it is going to the 1%. It is going back to the financial institutions, but we're having a lot of it go down to Main Street, to businesses, to individuals. And what could happen, what most likely will happen, is we're going to have more money chasing the same amount of goods and services. And what did we talk about in the beginning? What drives prices? 3 types of inflation. It's really all boils down to supply and demand. So if there's more demand than supply, there's more money chasing few goods and services, what happens? Prices go up. The question is, that I want to answer in this video is, are we going to see hyperinflation? Now, hyperinflation would be categorized more like I kind of gave the examples of Zimbabwe, Venezuela. And I would have to say probably not. I don't think we're going to see that because of a couple factors. One, the US dollar is the world reserve currency. So we have an advantage where we're not going to be subject to the same situation that we'll see in Venezuela, Argentina, Zimbabwe, etc. However, like I said, the law is supply and demand. And so if we increase the increase the demand without the supply, we're going to have the problem. There's no way to beat it. So the question is, how do we protect ourselves? All right. So you need assets that can keep up with inflation. So like take real estate, for example. In 1971, the median U.S. home price was $24,000. It sounds crazy. So in 1971, if you said, I don't want to buy a house right now, I have cash, I have $24,000, I'm not going to buy the house, I'm going to put it in the bank. And I'm going to put that money in the bank. And now today, in 2020, you said, hey, I'm ready to buy that house now. Well, guess what? You only have $24,000. It's not going to buy you a house because today the median home price in the U.S. is $300,000. All right. Now, so if you'd put your money in the bank, it wouldn't come anywhere close to buying a house. So, but if you put it in a house, it would have held the value. So we need to put our money into assets that will keep up with inflation. This is part of the reason why the rich keep getting richer and the poor keep getting poorer. The rich have assets that go up with inflation. The poor, they work for their wages and the value of their currency keeps going down and down and down. So we need assets that can keep up with inflation. So what should you do? What should I do? Well, the first thing we have to remember is that markets have cycles. So nothing goes straight up in a straight line and nothing goes straight down in a straight line. And so trying to time this is going to be very difficult. Now, will the $6 trillion create inflation? Yes, of course. Some assets will be affected more than others. But the timing, right? What is the timing? Is the stock market going to go down before it goes back up? Are home prices going to dip before they go back up? And so timing, it can be very, very different. So you need to kind of learn to understand this and see what your own personal conviction is. I do believe we'll see asset inflation. I don't see any other way around it. You put $6 trillion into the market and it's going to pump. That's it, right? We already saw it last week. It started pumping. Even though the job numbers are going up and up, and the unemployment numbers are going through the roof, we're still seeing the markets pump because of all that money. So in the short term, are we going to see prices dip before they go up? Possibly. So understand what your own conviction is, all right? Understand what your own exposure is to the market. What are the time frames you're looking at? Do you have a year? Do you have 5 years? Do you have 20 years? What's your desired outcome? And then based off of that, you need to move accordingly. But either way, one way or another, like I said, you're not going to be able to beat this. The law is that more supply chasing or more demand chasing fewer supply is going to cause inflation. So at a minimum, make sure you have some insurance. Now, when I talk about insurance, I talk about portfolio insurance. I talk about what I call chaos hedge insurance. Talking about gold. Gold's skyrocketing again today. It's doing really good. But any of these assets that can do really, really good in the face of $1 trillion stimulus coming in, gold stocks, etc. So that's it. That's what I got for today. Let me know down below what you think. Are we going to see hyperinflation or just inflation? Either way, I'd love to have conversations with each one of you. So I look forward to all your comments. Give me a thumbs up on the video if you like it. If you don't, give me a thumbs down. Either way, but let me know. And that's it. To your success. I'm out.